This evening, we're really pleased to present tonight's webinar, Affordability in the Veterinary Market. This is our kind of quarter four of 2025 report, and we got a lot to roll through. So we'll do our best, and we'll leave lots of time for questions at the end. If you have questions, we will answer most of them at the end of the webinar, but go ahead and type them in as you think of them, because if it's something that's related to the slide that we're currently on, we might just go ahead and answer it kind of in the moment. There's a Q&A box in the Zoom window where you can go ahead and ask those questions, and yeah, we'll address all of them. Additionally, you'll get a link in the chat window to Rich's Calendly link. So if you have a question that's very, very specific to your practice, your situation, don't hesitate for a second to book some time with him. He's very available and would be happy to speak with you. Just to give you a little bit of background on Ackerman Group, who we are, what we're about, why you should pay attention to us tonight. So we're actually the largest broker of practices in North America. Last year, we brokered 50 practices, more than any other advisor in the space by a multiple of two, at least, if not more. Additionally, behind all of those practice sales, we've reviewed dozens and dozens and dozens of offers from all of the different buyers that are in the space, which has permitted us to have really granular, real-time insight into the practice sales market and informs a whole lot of the data that Rich is going to share with you this evening. So you can consider it straight from the source, if you will. We have a very large team to support all of these efforts. And I would say that the work of all of these individuals that you see on the screen here all go into a lot of the education pieces that we put together, the research that we're able to build. It really is a group effort. And so while all of our clients do get to enjoy very personalized experience, there is a back office that's really supporting all of the work that we do to deliver kind of the highest quality knowledge on practice sales in veterinary medicine. Tonight's presenter is my partner, Rich Lester, CEO at Ackerman Group. Rich has a really deep experience both within the veterinary field and within kind of the mergers and acquisitions world, if you will. Prior to joining Ackerman Group, Rich actually founded one of the corporate groups, grew that for a long period of time, and prior to that, actually worked at one of the earliest consolidators that was in the space, Bright Heart Veterinary Center, that was actually sold to VCA way back in 2010. And so with that, I'm going to go ahead and turn over the reins to Rich, and we'll talk all about the quarter.
Thanks, Wayne. Now I got to figure out and make sure, there we go. I can keep moving the slides through. So the delay is sort of my fault. I have been away for a few days, and then getting back to the Northeast by plane has been a bit troubling. So I am, as I like to say, I'm stuck on a Caribbean island for a few extra days. And we were trying to make sure that Zoom allowed international folks to be in the meeting, which is a little bit of the cause of delay. So I apologize for that. I do hope to get back to the States in the next couple of days. Anyway, what are we going to talk about today? So we start at sort of a high level, sort of what's going on in the world and in the US, and we'll talk about affordability, regime change, and tariffs. Then we'll get a little bit more granular and talk about the veterinary services market and what's going on within our market. And then we'll present a whole bunch of data on transactions that we're seeing, deal structures that we're seeing, and things that, if you're considering a sale, are probably pretty important to your process. So we'll start with affordability, regime change, and the economy. And what I like to say about the news cycle right now is that it just moves really fast. Back in fourth quarter, the news was all about the Gaza war and the ceasefire, and thankfully that fighting has stopped. Then suddenly in early January, we instituted regime change in Venezuela. And after a week or two after that, then discussions around Greenland took over sort of international relations. And then Iran had an uprising. And so the point of all this is that there's a lot of uncertainty in the world and a lot of things that are impacting just sort of the stability of the economy and the world order. Businesses tend to crave certainty and consistency in government policy, but the reality is the stock market's remained incredibly strong over the last 12 months, despite this list of things that have been just going on in the last 3 or 4 months. And so it's been fascinating to see how world events that I would have thought would have been unsettling to businesses and investors are mostly being shrugged off, which is actually good for the veterinary sale market. What's going on now? That's the world. What's going on internally within the United States? And I think what we've seen over the last 5 months is slowing job growth. And that slowing job growth has led to changes in how the Fed is thinking about interest rates. And President Trump has been pressuring the Fed since he was, inaugurated back in January of 25 to lower interest rates. And they resisted for the first 7 or 8 months of his administration. And in September, rates started to drop. And the reason that the Fed started to lower rates is right here on this graph, which is you see for years we had this strong growing economy from a job perspective. And suddenly over the last 4 or 5 months, that's become very uneven. I've got a senior in college, and when I talk to him and his friends, it's a really tough job market, especially for 20 somethings and recent college grads. And that's weighing on spending and on the economy. But the reality is you've got a slow job market, but GDP growth or the overall economic growth has been really strong, and it likely will end up at north of 3% for the calendar year 25, which is a strong growing economy. And so it's a balancing act for the Fed on how to handle interest rates. And I'll explain how interest rates impact you and your practices. The Federal Reserve is meeting this week, and all indications are that they will pause on the rate cuts. And this graph, which I show at almost every webinar, talks about the relationship between inflation and interest rates. And so back in 21 and 22, during the COVID shutdown, inflation started to get really out of hand. The Fed reacted, as you can see, took till inflation was north of 8% for the Fed to start taking dramatic action to raise interest rates. And that had the desired effect of lowering inflation. Interest rates stayed consistent for a couple of years. And then for a year plus, then there was in late 24, there were some declines in interest rates. And then now again in late 25, there have been some decline in interest rates. And the reality is inflation has, since sort of mid 24, has hovered between 1.5% and 3%. And the last 2 months, inflation's been at 2.7%, which is higher than the Fed wants at 2%, but it's far lower than I'd say most conventional economists would have predicted. The biggest sort of mystery to me about what's gone on with inflation is every economist thought that the tariffs that President Trump put into place, and they're now really 9 months old because they started in April of 24. Inflation is actually below when he took office. It was 3% when he took office. It's now 2.7%. So the tariff impact so far has been virtually nil. And so when we think about what's going on in the economy, you've got pretty good GDP growth, you've got a soft labor market, and you got tariffs that aren't really driving inflation. And you've got this sort of policy quandary for the Federal Reserve. They've lowered rates, but they're sort of stopping right now, or they're likely to stop because the economy is still strong, and they're waiting, I think, for more job market data. And so what's been going on, that's sort of the economy. Now, when you think about consumer confidence and sort of political trends, I'd say over the last 9 months, the word affordability has become sort of the key political term. And Zoran Mamdani became the New York City mayor, running solely focused on affordability issues. And affordability is a huge issue in New York City, and it's become an issue with inflation around the country. And I think most folks would say that Trump and the Republicans haven't taken that seriously. So it'll be interesting to see. I think that'll change over the next few months as midterms come up at the end of this year. But the key thing for all of you as practice owners to think about is this affordability concern that's been talked about in the media has become a political issue. It may not impact the top 5 or 10% of earners, but it impacts a lot of pet owners. And when we think about veterinary industry growth, veterinary industry pricing, this affordability concept really plays into some of the industry dynamics. And so we have this uncertainty in the economy. We have an affordability issue. We've got instability overseas, which is sort of not what you would think would drive a high stock market, but the stock market continues to go despite all these things. So let's talk about the veterinary market for a few minutes and sort of we're going to talk a little bit about what I call the winners and non-winners in the market, in particular amongst the corporate groups. So we'll start with a slide that I also show every quarter. And unfortunately, it's been very consistent for the last 15 quarters. And what we've seen is consistent negative invoice growth. So invoices have been down 2 to 3% a year for the last 15 quarters, going on basically 4 years. So 2022 to 2025, the industry has had declining invoices. And why is that such a big deal? Well, there's a few reasons. One is if you extended the left side of this graph back to 2011, you would see 8 straight years of sort of 1% invoice growth and 4 to 6% revenue growth. During the 2010s, our industry was the sort of rock of consistency in growing invoices and growing revenues. And the investment capital from private equity firms all came into the market, or a lot of it came into the market in the 2010s, and that drove practice valuations up because basically what investors were seeing is in the 2010s, the economy grew 2.5% a year. Our industry was growing 5 to 6%. So when you grow twice the level of the economy, that feels like a good investment industry to invest in. The problem is we then took off during COVID and had tremendous growth. And then during that tremendous growth, where there were doctor and staff shortages, people took a lot of price and raised price. Now you've got that the consumer and pet owner saying, pricing's gotten high. There's now an affordability set of issues, sort of in the political mindset of people. And it's a challenging invoice market. And so what we would say is that there's strong industry headwinds in our industry with 4 straight years of declines. Yet pricing hasn't gone down. And so, for a year or two, for probably the last 18 months, we've said, hey, like this doesn't make sense, the market, i.e., there's a handful of, there's a bunch of buyers paying all this money, but the industry trends are really not good. Why is that? And wasn't really sure of the answer. I feel like as we've looked and studied the data, we kind of understand what's going on in the market. And here's our answer. And it's actually a pretty good answer because I think it'll keep pricing relatively high for a period of time. So there are a certain group of buyers who have proven to themselves over a number of years that they can execute post-closing and grow clinics at way better than the market, which is shrinking 2% on invoices. And so while industry fundamentals don't justify the valuation, we see sort of a tiering of buyers where thankfully there's a handful of confident buyers that are thinking that they can outperform the market post-closing, and they've proven it over a number of years, and that's driving their confidence in bidding things up. There are, in our view, sort of 3 to 5 buyers out there that are bidding sort of at the top of the market who have this confidence in themselves, and they're winning the best assets most of the time. Other buyers, there are a few who actually do believe in and are confident, but are not willing to pay up. And others just haven't proven their ability to grow practices, so they can't justify paying up. And so what I've started to tell our clients is as long as there's 4 or 5 groups that really believe in themselves and believe that they and can continue to demonstrate that they can grow practices post closing, I think we'll continue to see, pricing stay strong despite the industry headwinds. And so here's the data on closed deals that Ackerman Group has sold. So from the first half to the second half of 2025, multiples on general practices were essentially flat. We were at 12.5%, 12.5 times EBITDA in the first half of 25, 12.4 times EBITDA, so down 0.1 turns of EBITDA, nothing significant. And more importantly, over the last 2 months, we've signed 2 LOIs now at 16 times EBITDA or more. I like to describe both of these practices as, in some ways, near perfect, meaning 7 doctors, $1.2 to $1.5 million of EBITDA, not a lot of doctor turnover, relatively new buildings. And so they've gotten big premiums. And the pricing that we're seeing in the market for the best assets remains strong. So I see no reason why, at least in the first quarter or first half of this year, that we don't expect valuations to decline in any material way. We don't think that they're going to go up that much because we're selling lots of other practices that are at 10 and 12 and 14 times EBITDA. They're not all at this 16 times EBITDA. You'll also note, for those who looked carefully at this data, the way that we focused on the weighted average general practice multiples. The simple average and the weighted average multiples are impacted by some single specialty hospitals that we've sold, and single specialty hospitals tend to get a little bit lower valuations, and some of them are large transactions because there's so much key doctor risk in a surgery practice and a dermatology practice. Like, they're so hard to replace. Those multiples are a little bit below what we see for the general practice now. So I think another really important trend that we're seeing is it's not 4 or 5 buyers that are driving the market. We're very proud that we deal with a wide swath, basically every buyer out there. And in 2025, we had 15 different buyers that bought practices from us. And that tells us that the market remains robust and there's a lot of active folks. And I think as importantly, over the last 6 years, you can see the number of buyers we work with each year, but overall, we've worked with 34 different buyers in the last 6 years. So lots of buyers out there, but some are buying and some aren't. And if you're thinking of going to market or selling, it's really important to work with a group that understands what the strategies and goals are of each buyer so that they know and can help you get the most bids and the best pricing. And what we're seeing is that there's different geographic footprints. So practices in certain geographies get more bids than in others because there's some national players that are out there bidding on everything. And then there are some regional groups that will only bid in certain geographies. And I think the other key piece on this slide is just a commentary that we sold 50 practices this year. We think that the total number of hospitals sold was relatively flat from last year, from 24, where we sold 37 hospitals. So I think our share of the market has gone up. We'll have final data from our conversations with the buyers on our Q1 call to sort of give more definitive information about size of market, how many practices are being sold, et cetera. In terms of the types of practices that we're selling, this is a graph that helps show that the deal quality has gotten better or continues to get better. So the graph on the left is the average purchase price for each individual hospital, which peaked in 2021, but was at its most robust level in 25. So the best or highest valuations we've seen in 4 years. And then the same on the average EBITDA of the practices that we brought to market. We were actually almost at 2021 levels. The pricing's still a little bit below 21. So that's why the purchase prices are a little lower. But the quality of assets that we're bringing out to the market and the appetite for those has been really strong. And so the average EBITDA was up 38% on our deals from 575,000 last year to almost 800,000 this year. So what's going on with the buyers? And I've said that there's this sort of tiering going on of some who are more confident than others and they're willing to pay up. Many folks have heard the term recapitalization, and that's when one of the corporate groups decides to sell themselves to a new investor. And part of the problem with the market has been with interest rates high, they were 5+% for 23 and most of 24. Now they're getting below 5% and into the low fours. Those interest rates impact what private equity firms will pay for a consolidator because they borrow lots of money. And so most of the investors who have been in the business have held off selling the assets because they want to see interest rates lower so they can get more money. And so since 2022, there's really been only one major corporate group that has sold, and that's the merger of SVP and NVP, which created Mission Pet Health. The valuation of this deal back in late 24, it was good, but not great. It was sort of 17 to 18 times, which is well below the 20 plus that corporate groups were getting in the heyday of COVID. But it was important because it was the first major deal in 2.5 years. The problem has been we've done one deal now in 3.5 years because in the last 13 months, there's really been no other major recaps. And we know there have been a bunch of groups that have gone to market looking to sell. And the problem is they're not getting the prices that their investors want. And I go back to investors, just like the buyers, are more discerning, and there's sort of a tiering of corporate groups. So the corporate groups that have the confidence that they can grow and are willing to pay up for assets, those are actually the ones I think that investors will be most interested in. And there's a number of groups that haven't been able to grow practices after closing, and those folks are not getting the interest from the investment community. We did have Western Vet, which is a group out of Colorado, which has become a sizable player in the market. They did complete a significant equity investment, what's called a continuation fund, to bring more capital, but the existing investors did not opt to sell the business because they think they'll get better pricing in the future. And probably since 2021, People have been talking about when's there going to be an IPO of one of these companies, and will there be a good IPO, and how will that impact the market? Based on all the intelligence we're getting, we don't expect anything until 2027, and we'll see what happens in a year plus.
Hey, Rich, real quick, I feel
Yep.
like we're introducing a new term into the
Yep.
profession with continuation fund. I think that there
Yep.
might be a handful going on there. Do you want to describe to people exactly what
Yep.
that is?
Yep. So it costs a lot of money to buy veterinary clinics, and you can borrow that money. You can borrow a bunch of money from lenders, but at a certain point in time, if you acquire too quickly, you need more equity capital. And so a continuation fund is basically when a company goes out and says, "Hey, I don't want to sell myself yet, but I want to bring new investors in and give them a chance to invest in this existing business." And so that's what Western Vet did. They went out, found hundreds of millions of dollars of new capital from new investors without their primary investor giving up control of the business. Does that make some sense, Win?
Perfect.
Good. All right. Hopefully that was helpful. So deal trends, I'm going to spend a few minutes on a few things that we haven't talked about in the past after this first slide, which is stuff we've talked about. So the market, you know, when we think about the market and how it's evolved from 2022 to 2025, we think about it in a few different sort of ways and how deals are structured. And so, first, we always think about how much cash is being offered for deals. And in 2024, we saw cash at a pretty high level up front for a lot of our deals, and that declined in 25. And it's a little odd because interest rates started to go down at the end of 25, and they also went down a little bit in 24. We are starting to see more cash-rich offers sort of late 25, early 26. So I do think the numbers will go up this year, and that's because interest rates are declining. Um, we've been saying this really since 2022 that DVM retention continues to be really crucial. So if you are a seller or a practice owner and you produce a lot of revenue, a seller is going to ask you to likely stay at least 3 years post closing because it's not easy to find replacements. If you are in a rural and hard to recruit market, if you're sitting in Idaho or rural Iowa or a small town in New York, upstate New York, you're likely going to be asked to stay 4 to 5 years. And we're seeing associate retention incentives become the norm in virtually every deal. And I'm going to present some data on what those look like in a minute. As I said earlier, the best practices, insatiable demand, and best practices, we talk about at least $500,000 of EBITDA, at least 4 doctors, and in a good market, in a good building. And the pricing for the very best is now 14 to 16 times, and I'd say it's 12 to 16 times for the 4 doctor $500,000 market. And then the other trend that I think is becoming more and more popular is the corporate groups are realizing that aligning incentives with the doctors at the practice level by having the owner and or the associates stay owners in that particular location is becoming more popular. And almost 50% of the deals we did this year were joint ventures. And I think, back in 21 and 22, it was probably 20% of the market. So there's been a big change in the sort of acceptance and interest in joint ventures. So let's go over some new data. And I think this is a really important set of information that we put together in the last couple of months. So we always talk about associate retention, and those incentives are critical to any deal. So here's the data, and there's two graphs here. First is, you know, The lighter color is what was paid on average to associates in 24. The darker color is 2025. And so, and this stuff makes sense in for one to, if you have a practice with an owner and 1 to 3 associates, we're seeing for those practices, the associates were getting on average 140 to $160,000 of retention for each doctor. And this is general practices only. And actually, as the practices get bigger, the individual amounts going to the associates goes down a bit. And that's because each individual associate in a 6 or 7 doctor practice is incrementally less important than in a 2 or 3 doctor practice. And so the two key trends are one, from 24 to 25, associate comp went up about 50 to 55%. And then the second graph down here on the bottom is what is this as a percentage of the total transaction value? And so in 2025, about 4% of the total transaction went to associate DVMs, and that's up from 3.3% last year. This blue line down below is what is the buyer contributed versus the seller. My argument is usually what the buyer is usually always contributing the full amount. Sometimes they raise the purchase price and ask the seller to contribute some, but it's all coming out of the sort of total deal pool. But it's important to understand that associates are getting some of the value, but I would argue 4% is not a crazy amount of the total value. On some specialty hospital stuff, these percentages tend to be higher. We don't have enough data to sort of present it because we've done a handful of those deals, but not enough to have a good data set. But know that sort of the more an individual doctor produces, the more power they have and the more they get in these retention incentives. The other piece I mentioned that I wanted to talk about a little bit is the growing popularity of joint ventures. And, we brought to market a couple of deals where we had sellers in their late 40s and early 50s, and some of the groups that don't do joint ventures were sort of asking like, well, why don't they like our proposal? And I'm like, well, they're 50 years old and they want to work for 10 more years. Why would they want to sell the whole business? And that discussion led me to have our team pull together a bunch of data, which is sort of what do joint venture deals look like based on age of the seller. And so the lighter color are joint ventures, the darker colors are 100% sale. And then this is by age band. And so for our sellers in the last 2 years, this is 2024 and 25, 63% of the deals with doctors with an owner under 50 have been a joint venture, but a doctor over 65 is doing a joint venture only 20% of the time. I think this data is intuitively logical. Like the longer the runway, the more likely someone wants to stay an owner of their individual clinic and get cash flow from it. But it helps quantify that piece. And then the last sort of data slide I've got tonight, I think this is the last one, is sort of about cash and how much cash is in each deal. And so as you can see, in 2024, 81% of our deals had 70% or more cash up front. But in 2022, 23, and 25, that number was about 42 to 45% of the deals. In 2024, there were a variety of reasons that it was sort of an anomaly. I do think that based on early indications for 2026, that this number may go up a bit, but we will see. Time will tell. So now let me do a few summary slides and then we'll take lots of questions, hopefully. So, just on the presentation, the world is in a lot of flux. The Fed's lowered rates. The job market has softened. Interest rates are likely on pause for now. We've got issues in Venezuela, in Greenland, in the Middle East. We got NATO stuff going on. So how that will impact the economy and sort of appetite for business. Right now, it hasn't at all. So hopefully that stays. And the affordability issue, I think, is a really important one for practice owners to understand and think about, especially as price increases are typically done end of the year or beginning of the year. I am unsure if the vendors in our space, the pharmaceutical companies and the lab companies in particular, are thinking about affordability, but hopefully they are, and they're measuring and scaling back some of their price increases. The veterinary market, as I said, invoice declines for 4 straight years, yet 2025 saw really good valuations. They were stable throughout the year. We're seeing sort of this tiering of buyers, of some who are much more confident and willing to pay up despite the industry headwinds, and the associate stuff is key. And so overall, industry fundamentals are weak, valuations are really good. Hopefully that continues. So now a little just about Ackerman's sale process and how you guys, as practice owners, may want to think about things. When we talk to clients, we typically talk about thinking about 3 legs of a stool when thinking about when is the right time to transition to a potential new buyer of your clinic, or selling or partnering with your clinic. And so the 3 pieces of that stool are: one is the owner, you as owner, are you emotionally and financially ready to do this? And that's not always an easy answer. We see a lot of doctors who are very wrapped up, their identity is as this owner of this practice for decades. And it is an emotional decision that they need to get their arms around. The second piece is sort of, where is the practice at? Is the business doing well? Are you short doctors? Have you just hired doctors? How's the profitability? And the third leg of the stool is, what's the market doing? And what we say typically is, rarely do you get all 3 legs of the stool in really good shape at one time. And if you do have that, sell or do your transition process. But if you have 2 or 2.5 of the legs, it also is usually pretty good. The next is just a way to think about whether you need, if you are going to go and sell your business, whether you need a broker or not. And we are seeing brokers involved in probably 60 to 70% of the transactions that were done in 2025. So as the complexity of deals has gone up, more and more of your colleagues are choosing to use brokers, but there's still a number of DIY or individual sellers out there. And what we're trying to show on this slide is, like, when the corporate groups send out their business development representatives, they're all super nice people and likable, or else they wouldn't be in that job. But you need to know that there is a lot of thinking and financial horsepower and legal horsepower behind those friendly corporate development executives. And those folks are thinking about trying to get a deal done, but they're not looking out for your interests. They're not trying to get you the best deal. They're trying to get themselves a really good deal. So make sure you have good representation, because the friendly, likable business development executives are just that, but they're not looking out for your interests typically. They're looking out for their employer's interest. And then finally, that last slide is sort of, why should you use a broker? This is a slide that's a little complicated, but it's a little bit about why, if you need a broker, you should work with us at Ackerman Group. And I think the core to it is that we are doing a lot of things that other brokers tend not to do. So the things in blue at the beginning and at the end of the process are things that most brokers don't provide. And I'm not going to go through every box here, but the sale process is complicated and long. There's a pre-launch and analytical process. there's going to market to find buyers, there's signing a letter of intent, there's a sort of LOI to close process, but there's also a post-close process, i.e., once you're partners with folks, there's a lot of stuff that's still not finished in your deal. As I've shown you, most deals have less than 70% of the payment of cash up front. That means 30-40% of a deal is being paid to you post-closing. And who's going to represent and help you make sure you get that money? That's one of the most unique things that my partner who founded Ackerman Group, Gary, set up in how we operate, which is we have a fee structure where we only get paid when you get paid. So we have every incentive to stay and work with you a year, 2 years, 3 years after your close. So that's a little bit about Ackerman. Now I'm going to open up to questions in about 30 seconds. But first, two quick ads. One is for those of you who are planning to attend the Western Veterinary Conference, we are hosting a sort of drinks, happy hour, and appetizers at Libertine Social. Scan this QR code if you want to register or email one of us. We'd love to meet any of you at this event at Western if you're going. It's Monday night, February 16th. And then last but not least, and please, if you have questions, please start putting them up. We've started 4 years ago our Insightful.vet conference, which is really the only veterinary conference exclusively targeted towards practice owners. We had over 120 people, about 90 practice owners in Dallas in November. And this year in Atlanta, we're doing the conference at the Ritz-Carlton in November 12th to 14th. Again, there's a QR code. Insightful.vet is the URL to find out more about the conference. It is primarily about how to run your practice better. It is not about how to get the most, the sale process. This is all about helping educate practice owners on opportunities and ways to improve their existing practice. So that brings me to the end of this session. I went a little longer than I usually do, but hopefully the information was useful. Now I've got to figure out where these questions are. So there are some questions here. All right. And so please type in questions to the Q&A, and I'm going to now walk through a bunch of these. Are some of the large investors who completed transactions in 21 and 22, example, Vetcore acquiring People's Pets and Vets, seeing impairments to their valuation now compared to those closing values or enterprise values? So the answer to that is certainly that has happened. So there are, almost every large corporate group took in a new investor in 2020, 21, or early 22. And some of those investors have seen those investments perform poorly. I'm not going to name specific names, but there were groups that were very active acquirers in the late 2010s and early 2020s who are no longer acquiring. The surest sign that a group has sort of had financial issues or seen impairment or has too much debt is that they stop acquisition activity. And there are a number of those out there. If there's a purpose, I can talk offline to someone. I don't want to talk negatively about some of the corporate groups out there. Many of them are working on fixing themselves and getting stuff done. But the way I would put it is there are 5 groups with over 200 hospitals that, 5 groups with over 100 hospitals that are no longer acquiring. And there's probably 6 or 7 if you take that number down to 50 hospitals. And so if you haven't acquired a hospital in the last 3 years, odds are there's some financial issues there. So Jacqueline asks, For retention of DVMs, the 140 to 160,000, is that on top of salary? How is it paid out? So yes, that is a what we would call retention incentives, and those are incentives for the doctors. Those are not, and I repeat, not all paid out at closing. They are paid out over time, usually smaller amounts in year one at closing and larger amounts at the end of year one, two, and sometimes year three. They're typically paid out in three or four installments, sort of at closing at the end of year one, at the end of year two, and sometimes they go out to 3 years. So hopefully that helps. But hopefully I didn't give anyone the impression that that much money is going out all at closing, because that's definitely. So John is asking, how are mobile and house call practices selling? I would say quite simply, they're not selling well. Um, the Vets was the largest mobile veterinary sort of consolidator out there, and they basically shut down business in 2025. There are some folks that are running house call businesses, but they tend not to buy them. They tend to recruit doctors and help them set up practices. So, and most of the corporate buyers are not buying house call practices. I mean, they're nice businesses, but they are not sort of core to what most of the corporate groups are doing. Um, an anonymous person says, is the post-closing amount still tied to how the practice performs post-closing? So if that's referring to retention incentives for the doctors, the answer is no. If you're talking about what a seller receives post-closing, it depends on the deal and the deal terms. So I'm going to give a few examples. If a seller gets a bunch of what's called top co-equity or equity in the parent company, not in their hospital, that's really not tied to how an individual practice performs. I like co-equity. You're betting on the buyer and their management team, and you're not betting on yourself. And sometimes people offer what are called contingent notes, and those have some reliance on how the practice performs post-close. A lot of times there are earnouts in deals, and that's always tied to post-closing performance. So it depends on what you're talking about, and what deal structure is actually in place. So an anonymous person is asking a very specific question. Is NVA, National Veterinary Associates, buying again? So they put acquisitions on pause probably in 2022. We've had a lot of discussions with NVA, and I think that they will be looking at buying hospitals. Unsure whether that will be the US or Canada or both, but I think they will certainly be signing LOIs in 26. We'll see if they actually close anything this year. So Jason asks, what is the retention time frame for associates who remain after the sale of the practice? So the associates don't have to stay more than a day, or they don't have to stay at all. But to receive the retention incentives, they're usually being asked to stay 2 to 3 years. And that's for associates who are retaining, who are just getting cash payments. We are seeing with this joint venture trend, a number of groups are trying to get associates to buy into the practice and become partners in the practice. And if that happens, then they usually are making a more like a 5-year commitment to the practice if they're becoming an equity owner. Hopefully that answers Jason's question. All right. We've been through at least a half a dozen questions. It's getting closer to 9 o'clock. if you have more questions, I appreciate we've had very few of you drop off during this call, so I appreciate you sticking with me for this long. And hopefully those of you on the East Coast and in the Midwest who've been hammered with this storm are staying warm. But I'm gonna, unless,
Rich, I got another question for you.
go ahead and before
So this
we,
morning, consumer confidence dropped even further now to a 14-year low.
Mhm.
And at VMX, I was asked whether or not there are any buyers for practices that have consistent negative invoice growth. What should we tell folks about that in case things aren't going swimmingly at their practices these days?
So I think, and this is a hard one because as with everything, the answer depends. So if you've had consistent negative invoice growth and you're sitting in a small town in an old building, odds are there's not going to be a buyer for you. But if you're sitting in Charlotte or Atlanta or in the Chicago suburbs and you've got a nice building and you can't grow invoices, most buyers would say, this is an opportunity. Like I've grown, we have other practices in these areas and we are able to grow them. I think we can have confidence in our marketing ability and we can buy this and hopefully turn it around. And so I think negative invoice growth doesn't mean you can't sell a practice. It makes it harder. It will get you a lower multiple, and it's very geographic and building dependent. Does that make some sense, Win?
Yeah. And
Okay.
we had another question, whether we're going to send a recording of the session. And the answer for all attendees is that yes, we will send out a link to a recording of this, if not tomorrow, then on Thursday.
Okay. Again, I thank all of you for attending. It's our pleasure to do these things. We're very proud of the data that we're able to put together. The analyses that we do, we think are unique for the industry. And our goal is to continue to educate the market about what's going on so that when people are making decisions about their practices, they're making informed decisions. So look forward to seeing and working with some of you and thank you. Lou, I got one last question. Matthew's asking, sellers' incentives are normally tied to production. Hmm. I the seller's incentives in a transaction are usually more tied not to their individual production, but and they usually get paid salary and production, but their deferred purchase price is usually tied to the performance of the hospital. Sometimes it's tied to the performance of the buyer in general, but it depends on the seller and their incentive. Again, so Matthews, we have some sellers who are in their mid 60s, and the plan is, hey, they're going to continue working full time until we find and recruit a replacement, and then they can work part time. And so their incentive is not necessarily tied to production. It's in that case tied to finding and bringing on the new doctor. And so lots of different situations depends on the individual deal. Okay. All right. That I think gets us to the 9 o'clock hour. It's actually an hour ahead in Barbados. It's almost 10. Um, so please don't feel sorry for me where I am, even though we're sort of stuck here because we can't get a flight home. But it's a pretty wonderful place to be stuck. So everyone else, if you're in, again, stay warm. I hope your staff are able to get to practices. I hope your clients are able to come in despite the real awful weather we're seeing. And thanks again, everybody. Good night.